Yeah.
When silver really catches a bid, the list of stocks that you have named is going to outperform the list of stocks that I own.
Welcome back to Metals and Miners. I'm your host, Gary Bohm. And today we're diving deep into the dynamic world of resource investing, precious metals, and the market forces that are shaping our future. I'm thrilled to introduce Rick Rule, a legendary figure in the natural resource sector and founder of Rule Investment Media, Rule Classroom, and the Rule Symposium, which, Rick, you are once again hosting the exciting Resource Investor Conference in just a few short weeks down in Boca Raton, Florida, which I'm very excited about. And with decades of experience as a resource investor and an incredibly sharp eye for market trends, Rick's insights cut through all the noise, offering clarity on opportunities and risks in today's volatile markets. Rick, it's always an honor to have you back on Metals and Miners. Welcome to the show.
Well, it's my pleasure to be with you. Thank you for having me back, and I look forward to hosting you down in Boca Raton.
Yeah, it's going to be a lot of fun. Okay, so Rick, let's begin with the recent announcement that China is going to be releasing some critical minerals like rare earths that they put on an export ban on the U.S. recently in retaliation to Trump's tariffs. If China is expected to release critical minerals essential to the U.S., obviously and clearly, the U.S. had to offer some specific concessions behind the scenes. Doesn't this indicate a notable shift from the current White House administration's prior stance on trade and mineral independence?
I'm probably a better metals analyst than I am a political analyst, but I assume that Mr. Trump's tactics are governed by the book, The Art of the Deal, which is to say he's totally transactional, uh, not ideological. Ideology is how he gets elected. Transactions is what he does after he's elected. So I'm sure there are some quid pro quos, but I think the markets are important too. It's critical to understand that rare earths aren't rare. We haven't looked for them because the Chinese produce them so efficiently, well, relative to other countries. The Chinese have begun to look at the discoveries of rare earths in Malawi and Brazil, among other places, and they've seen that the cure for high prices is always high prices. And to the extent that they let market forces prevail, uh, the global dependency on the Chinese supply chain ends. I think that's very, very important to understand. There are some important rare earths discoveries on a global basis, and the Chinese ban led to an increased sense of urgency on the part of Western governments, and that translated to official state sector support, which is a different way of saying a very low cost of capital to people in the rare earth space. And I think the Chinese, much like they did 15 years ago, saw this and thought, you know what, we got to moderate what we're doing. It's also worthy to note in rare earths that one of the reasons why the Chinese were such low cost producers is because the environmental standards around their production in Xinjiang were horrible. And neither the Chinese people nor the Chinese state put up with that anymore. So the production costs, which were so low that made the Chinese so competitive, have risen rather dramatically. And the Chinese look at the impending commencement of supply in various parts of the world with supply chains that are no longer uncompetitive with them and see that they have to cement their relationships with suppliers now or risk losing them.
Yeah. So I just want to point out to you that while you don't consider yourself a geopolitical analyst, I think many do appreciate your geopolitical perspective because of math, because of economics, and because of your reach and understanding globally, from an economic and resource perspective. And it does drive a lot of geopolitics. So we do appreciate what you have to share there. So gold is increasingly replacing U.S. Treasuries in central bank reserve portfolios in recent years due to the fundamental shift in risk perception that was primarily triggered by the freezing of Russian foreign reserves back in the first quarter of 22. It's introduced this tail risk, this political confiscation tail risk for the non-G7. Because of this new confiscation premium, nominal yields now need to go much higher to entice a shift back to treasuries and away from gold, which is what they've been accumulating since. To the non-G7 and possibly even others around the world, Rick, are U.S. treasuries now junk unless yields essentially double or more from here? And if not, basically, is gold likely to continue rising as is clearly the safe asset of choice by these countries?
Junk is the wrong phrase. My friend Doug Casey famously says the US dollar is the worst fiat currency in the world with the sole exception of all the others. I maintain liquidity in fiat currency. I save in gold. Getting back to your question, I suspect that political risk is one thing. The U.S. weaponizing the SWIFT banking system, which is not our property, imposing our political will extraterritorially, and then stealing the Russian assets, irrespective of how you feel about Russia. It's worthy to note that Germany is a G7 country. They said to the U.S., yes, we appreciate everything that you've done for the world economic system. Send us our gold back, please.
Exactly.
The other thing that you need to think about in the context of the U.S. 10-year Treasury or the U.S. 30-year Treasury relative to gold is that arithmetically, the Treasury is not a very good deal. Yes, you will get paid back because they can print. But let's look at the arithmetic around the U.S. Treasury. My belief, and this is probably controversial, is that the CPI is a lousy metric to measure inflation. If you describe inflation as the deterioration of the purchasing power of your savings in fiat currency, my belief is that the purchasing power of my savings relative to the basket of goods and services that I consume is somewhere between 7.5% and 8% a year. The CPI says 2.5, but they shop somewhere that I don't shop. If you are receiving 4.5% interest in a currency where the purchasing power is declining at 7.5% a year, you're losing 3% a year for 10 years. The Chinese have looked at that and said, we're assigning seigniorage to somebody who regards us as an enemy, while at the same time losing 3% a year in purchasing power. We can probably generate a better return than that in our own country or in countries that believe themselves to be friendly to us. I think that's what you need to understand. Is this going to be a sea change that happens overnight? Of course not. Gold bull markets are very, very, very long, real ones in duration. The first one of my career took place 1970 all the way to 1980, a 10-year bull market. And by the way, in the middle of it, in 1975, the price of gold fell by half. So if you're in the gold trade, and you should be, understand it's not going to be a steady progression of higher highs and higher lows. There's going to be perturbations. You will do well following arithmetic, but you will be subjected to a lot of volatility.
Yeah, and I think it's important, your point there about, it's like moving the Titanic, turning it around versus a speedboat. These things don't happen overnight. And just because because gold is consolidating or maybe goes down a couple of $100, in the ticker, doesn't mean anything's really changed. The entire thesis, the entire reason for the gold move since last March is still in place. Rick, U.S. federal deficits are projected to surge to 3 to 5 trillion annually within 5 years, alongside declining tax revenues due to slowing growth, rising social obligations like Social Security, and an expected accelerating decline in the dollar's value due to the government's explosively growing spending policies. How likely is it that this environment is going to spark the perfect storm of overvalued equities, real estate bubbles, and weakening bond markets that could lead to a panic demand for precious metals from the public?
I'm probably the wrong guy to ask that question. What you're talking about is popular culture and popular narrative. And I'm a loan shark. That isn't what I do. I don't own a TV. I don't know how to dress except for battle bank shirts. In terms of describing the narrative, I'm not very good at it. I can tell you that the cap rates on conventional real estate scare me. They seem high. When I look at the ability for real returns in real estate to exceed the cost of capital, it seems to me in a lot of real estate assets that the wind is no longer in my sails. And I was a real estate investor for 25 years, 30 years actually. Uh, Similarly, I can't tell you about valuations in all sectors because I only understand two well, natural resources and financial services. I believe personally that inflation is much higher than most people believe. And as a consequence of that, I think that the long bond market is a really ugly trap. And if the long bond market falters as substantially as I think it will, the multiples associated with both real estate and equities markets will get hit and hit hard. Notice I said if, not when. I'm not certain that this is going to take place, but I'm certain enough that I'm maintaining fairly high cash reserves and I'm sticking very close to my knitting. It's worthy to note that a guy who's a pretty good generalist investor, a Midwestern guy, what's his name? Buffett. Yeah,
Yeah,
that guy has a third of $1 trillion in cash.
amazing.
This is a guy, by the way, that did very well in the 1970s. When equities indexes went nowhere, he generated a 20 or 25% compound annual internal rate of return. This is a guy who's a pretty good picker. By his rule of thumb, which is aggregate equity markets valuations relative to GDP, the market is in 200% overbought territory. I'd probably rather rely on the Buffett indicator than the Rule indicator because Rule never spent much time trying to understand that.
Okay, so let's talk about the natural resources here. In a global financial landscape where so many trillions of printed fiat money have come into existence in just the last 5 years, it's peculiar that commodities currently trade at such historically depressed levels relative to stocks. What are the primary catalysts that would most powerfully drive a significant mean reversion in the commodities to stocks ratio, in your opinion?
Let's look at the cause first. I agree with the description. In the dichotomy between the gold price, which has risen, and the gold equities prices, which haven't risen until recently, that's easy to explain. Gold had a bid from foreign central banks, and foreign central banks don't buy stock. An asset class that had a bidder went up, and an asset class that didn't. With regards to industrial materials and other forms of natural resources, the markets are pricing in a recession. I'm not smart enough to tell you if we're going to have a recession, uh, although my gut instinct is we're overdue. But in a recession, you can have the odd paradox where supplies are falling due to scarcity. That's going to happen in resources. But if demand falls too, prices don't have to go anywhere. So you're seeing in the weakness of the oil price, despite falling oil production, markets forecasting a depression and actually experiencing a decline in demand, near-term demand. You're seeing the same thing in copper. So I think that in non-gold natural resources, what you're seeing is broad fears uh, of a recession and perhaps the early signs of reduced demand due to economic stagnation. How much of that has to do with the tariffs and the expectation of weaker U.S. demand? I don't know. This I can tell you. If you look out a little bit, and by a little bit I mean 5 to 7 years, we are as a society, as a people, not just the US, but around the world, underinvesting substantially in the productive capacity around natural resources. We've underinvested in copper for 30 years. We're underinvesting in oil and gas. We're underinvesting in a whole bunch of places. And these are capital intensive businesses. If you underinvest or you scrimp on sustaining capital investments, you impair your ability to produce. We are going to have supply shortages, even against current demand, never mind future demand, and we're going to have it in the 5 to 7 year time frame. There's no getting around that. In the interim, prices can go lower because supplies now are adequate, and if demand falters, that impacts price.
All right. So since they're building, since the markets have already built in a recession or depression, as you've put it, how much further could they fall in the event that the real economy actually does slip into something like that? Versus on the flip side, what's the upside if at some point the market realizes, hey, that recession or depression just isn't coming?
Well, the upside's wild. It's truly wild. I've been through three prior natural resource bull markets in my life. And what happens when consensus arrives around a business that is as small as many of these businesses is dramatic to the upside. But I need to tell you that these bear markets can take longer to unfold than most of your listeners are prepared to accept. I remember in 1982, everybody talked about the natural gas bubble and how the bubble was burst and how eventually supply and demand would take hold. The oversupply that was generated by the overinvestment in the 1970s and the weakness in demand that happened as a consequence of the recession in the early 1980s meant that that bubble turned into a sausage. In fact, the industry slogan, which was survive till 85, didn't occur until 1989. The period 1981 to 1989 was characterized by the gas sausage. So people whose investment portfolios are fragile, which is to say, people who are invested beyond their financial and psychological means in any given commodity, are making a mistake. Participate to the upside, to be sure, but understand that these circumstances can take longer to unfold than you had expected and can subject you to absolutely breathtaking volatility before they occur. One of
Yeah.
the advantages of being 72, you know, I've been there, I've seen that, I've done that. I'm perfectly uh, prepared to endure a lot of volatility, a lot of risk, because the rewards I've enjoyed in my life when I've been right have paid rent on all the misery that I subjected myself to on the way.
That's a good way of putting it. And if you spend any time on X, you really do see the misery. The misery index is pretty high for so many people that they've gotten out. As you say, they struggle carrying the stock over a long weekend when they have the thesis, being out 3, 5, 10 years. But you really see the toll that the emotional side plays on some people.
The narrative always seems to overwhelm arithmetic. I guess people would rather feel than think.
Yeah.
One of the things that has been useful in my life is developing over time the discipline to look at noise from a different perspective. When I ran a large retail brokerage firm, one of the things I would do is check with my cage every day. And if the preponderance of buy tickets over sell tickets was more than 4 to 1, I'd make myself sell something. And if the preponderance of sell tickets to buy tickets was more than 4 to 1, I'd make myself buy something. In other words, in the short term, where there's a frenzy in one direction or the other, the market is always, always wrong. And I think that X is a similar indicator. Uh, I monitor X pretty extensively. And I remember 5 or 6 months ago, around the uranium trade, there were people who had uranium as part of their X handle. People who had cast their reputations on it, and they were quitting in disgust. No
Yeah.
sign more bullish than that. No sign more bullish than that. And I was able to put a trade on. Not that I needed any more uranium stocks. I had a boatload of them. But the truth is, I had to take a trading position because the sentiment around uranium was so ridiculously hostile. Now, the sentiment is very, very, very different, and I need to tell
Yeah.
people, not my core position, but my trading position's gone. It's cash.
So I do have a uranium question for you in a moment,
Great.
but today's been a big uranium up
Yep.
day. So yeah, so I do in a moment. Let's look at silver for a second here, Rick. The iShares Silver Trust, the SLV, has seen record high year to date inflows, and its price has surged to a 13-year high. What are these rising inflow trends in the silver ETF and the underlying commodity? What do they imply for the outlook of silver equity prices moving forward?
Nothing so far, because we don't have enough duration. Uh, we need duration. A lot of silver's newfound friends are traders. And should the market, for one reason or another, turn against them, even a couple ticks, they'll be history. Inflows into physical silver, if they're sustained, and by sustained, I'd need to see it for a quarter, mean to me, based on history, that the generalist investor is coming into the precious metals space. Precious metals bull markets always follow the same trajectory. They're led by gold, the fear buyer. And when momentum in the physical attracts attention, but also increases the margins of the producers, leadership changes from the metal to the equities. We've seen that happen. That's the second stage of a gold bull market. The next stage is predictable too. Value arbitrages come to exist between the best of the best, the biggest and the finest gold companies, and the best of the rest. And either the shares of the best of the rest go up, or the big guys take over the little guys. And then comes the silver trade. When the momentum in gold and the momentum in the gold equities attracts the generalist investor into the precious metal space, for reasons I don't understand, but I suspect it's lower unit cost, uh, leadership changes from gold to silver. If we see continued inflows, uh, retail inflows into the popularly traded silver physical ETFs, and particularly into the Sprott Physical Trust, uh, a less volatile vehicle, you will know the game is on. By the way, the price movement that you will see in silver means that you won't need Rick Rule to tell you the game is on.
So I'm assuming it's your speculation that uh, if things continue as you said for the quarter, then the game is on. But your hunch is that things might be moving in that direction because the other bullet points have been met. But on the mergers and acquisitions side, we haven't seen a tremendous amount. We've seen an uptick, but we haven't seen a tremendous amount. In what we've seen so far, is that enough to say that box is checked for you?
No, but it's coming. I mean, there's
Yeah.
zero doubt. There's very little doubt in my mind that the gold trade continues, at least in nominal terms, because of what I see as the inevitability in the decline of the purchasing power of the US dollar and the
Right.
inevitability of negative real interest rates. By real interest rates, I mean the delta between nominal rates and the deterioration of the purchasing power of the currency.
Yeah.
If the gold price continues strong, the margins of the best producers will continue strong. Uh, their share prices will increase at the same time that their free cash flow increases. And their only way to maintain
Mhm.
production is going to be to buy other people. That's going to happen.
Yeah.
At the same time, guys like Rick Rule, who thought that Franco Nevada and Wheaton Precious were dirt cheap 3 years ago, will begin to look for sectors in the market that, while risky, are relatively cheaper. And so it's a virtuous circle. The big guys, the
Yeah.
liquid guys with the high stock prices, the low cost of capital, take over the little guys. And if they don't get there quick enough, guys like me do.
Or hopefully, maybe some in the market will get there quicker too,
Absolutely.
but probably not. So we're talking about this recent surge in silver prices, which today it hit 37. I'm not sure where it is right this moment, but at one point today it hit $37. There's been an increased interest in these silver focused ETFs, as we just mentioned. Are any of the following junior silver miners currently on your radar, and why? Guanajuato Silver, Avino Silver and Gold Mines, Discovery Silver Corp, BlackRock Silver Corp, Defiance Silver, Santa Cruz Silver, and Silver Mines Limited.
Of those, I own Discovery uh, because I have a sense of humor for the guy who runs it. The rest of them are highly leveraged silver producers. Ironically, the highly leveraged part means that they're high cost producers. Their margins spread faster than the more efficient producers. I've chosen in my own portfolio at age 72 to favor quality over leverage. So the list of silver producers that I would own are companies that ironically will underperform the index as the silver price goes up, but will still yield me spectacular returns, but also yield me no operational risk. There was a time in the early part of the decade of the 90s when silver optionality was free, when nobody believed the silver price was ever going to run, ever under any circumstances. And you could you didn't have to buy silver optionality. The market gave it to you. The consequence of that was that Pan American Silver and Silver Standard both ran 40 to 1 in 5 years. The consequence of that is that the market has cottoned on to optionality. And now, relative to the delta between the silver price and the silver equities, people overpay for optionality. And I hate overpaying. Now, when, and I say it's I believe it's when silver really truly catches a bid, and by the way, I don't care at all about a $3 move. A $3 move
Yeah.
to me is like inhaling and exhaling.
Yeah.
When silver really catches a bid, the list of stocks that you have named is going to outperform the list of stocks that I own. And I'm okay with that in my declining years. Let's say that I make
Is the
or a
catching
quintuple as opposed to making an eight bagger, but I take away the operational risk. I'm on that trade like white on rice.
Yeah, that makes sense. Is the is the catching a bid time frame, is it after the record $50
I have
price,
no
or
idea.
is it maybe before?
I have no idea.
Oh, I was thinking in your analysis.
Again, you're asking me a narrative question, and I'm just not any good at that. Uh, I
Okay.
don't know what lights the spark. I'm a persistent storyteller, but I'm not a good storyteller. So
I was asking a math question there, in my opinion, but that's fine, no problem. Let's move on. So, with investor apathy, let's go back to the energy sector and oil here. Okay, so with investor apathy towards the energy sector, it at its peak, and the sector's near record low weighting in the S&P 500, and oil's historically low valuation compared to gold, alongside a projected but under-recognized structural decline in non-OPEC supply, notably that folks are saying, they're reporting that shale oil is plateauing. Um, these are similar catalysts to the 2003 to 2008 oil bull market. What specific areas or subsectors within the crude oil complex offer the most attractive investment opportunities and the downside protection that you like in your
I think
analysis?
you can start with Exxon. Let's go to the best of the best. A major integrated with a 30-year track record of intelligent deployment of capital, efficient upstream, efficient downstream, with a discovery in Guyana big enough to move the dial for Exxon. A circumstance where the industry is underinvesting, according to the International Energy Agency, $1.5 billion a day in sustaining capital. And Exxon is increasing sustaining capital investments and bought Pioneer for $60 billion. For most Americans, smart, lazy people, I aspire to being lazy, by the way, you can basically buy Exxon and relax for 5 years. Will you be happy at the end of 2025? I don't know. But by 2030, you'll be ecstatic. We talked, oh God, about a year ago, I guess, you and I, maybe longer, about the fact that the US natural gas stocks were felony cheap. And gas was felony cheap. It's no longer felony cheap, it's merely cheap. So some of that's out of the trade. But the truth is that Devon, Equitable, the bigger, better US gas producers have a long way to go. As the oil price recovers, it will drag gas along, and gas is already up by 100% in 2 years from an oversold bottom. The real wild card to me is the Canadian sector. The Western Canadian Sedimentary Basin is a spectacular basin that is very lightly drilled compared to US basins. Canada has a pretty good energy infrastructure, transmission infrastructure. They have great human resources. They have a good provincial regulatory environment. What they have had for the last 10 years is a federal government that was hostile to the existence of the industry. The new prime minister is sort of schizophrenic. He suggests that carbon discussions will be central to financial policy, which suggests he's not friendly towards the energy industry. But then he says that they need to make Canada an energy superpower. My hope is that because he is a banker, he understands that the country is broke and that in order to fund his domestic spending priorities, he will need to steal more money from the oil and gas industry, which means he will need an oil and gas industry. Perverse, But if that's correct, a basket of decent quality, mid to large cap Canadian oil and gas stocks should do spectacularly well in the next 5 years. They're selling for half the price of their US peers, and their US peers are cheap. The risk that you take is that the political establishment in Canada, if you will, the Laurentian elites, are hostile to oil and gas, and they'll have to deal with that headwind. In the United States, by
Yeah.
contrast, irrespective of what you think about Mr. Trump, he is changing the regulatory climate around oil and gas,
Yeah.
repealing existing executive orders, telling the regulatory agencies to get the lead out, not changing necessarily the regulation. But I suspect that the U.S. oil and gas industry will have 4 years where they have dramatically different relationships with the regulators than they had under Biden.
Yeah. Yeah. Okay. Let's shift back over to uranium here for a moment, Rick. The prices for uranium appear to have bottomed on April 7th, followed by a surge in many U.S. listed uranium stocks. In your analysis, does the recent market activity indicate the start of a new uranium bull leg since that early April timeframe? And if so, what factors are fueling that
Well, I
momentum?
don't think that the bull leg was over. I just think that we had a cyclical decline in a secular bull market. One of the explanations of that, well, there are related explanations. One of it has to do with the fact that while the pace of legislative restarts in Japan has been high, the pace of physical restarts has lagged it. And the demand that many people had factored into their models, myself included, was wrong. That had two impacts. One was a lessening of demand relative to models. The other thing it meant was that inventory that was held by Japanese reactors that I had anticipated would be moved into a slot called held for fuel remained in a slot called held for sale. The Japanese utilities didn't sell that uranium, they leased it. But about 10 or 12 million pounds of supply that we didn't believe was there came into the market. It wasn't sold. They did a clever thing. They gave it to other people to return today with contractual obligation to return it as fuel as opposed to money going forward. So we've really displaced demand. Uh, I don't know this to be true because the trading community is extremely opaque. I have reason to believe that that Japanese overhang is completely out of the market today. Whether or not that's true is a different question. There is also a growing concern about the political turmoil within the ranks of what used to be called Kazatomprom. And the sense that the politics of Kazatomprom are beginning to favor Eastern Bloc supply chains as opposed to Western supply chains. And I think there is an increasing sense of urgency among some consumers to begin the contracting cycle as a consequence of that a little early. I want to caution your listeners, Gary. They pay slavish attention to the spot price because it's an easy statistic to gather. The problem is that it's a factoid. Um, the spot price is extremely illiquid right now. Most days, the Sprott Physical Uranium Trust trades much more volume than spot uranium, which is to say, the Sprott market is in some danger of becoming the spot market. But a more important fact is that more and more of the uranium trade is conducted in the term market. And the term market is useful for the uranium business because, unlike any other commodity in the world, you lock in prices and volumes for 5 years, 10 years, 15 years in the future. That lowers your cost of capital and increases your earnings visibility. Not one in 1,000 uranium speculators is paying attention to the term market. I suspect because they'd like to, it's easier to feel around the spot price than it is to think around the term price.
Well, this has been an awesome discussion, as we always have, Rick. And I want to welcome everyone who's tuning in to the fantastic interview with Rick Rule, founder of Rule Investment Media and the Rule Symposium, among other businesses. Before we wrap up with our final set of questions for Rick, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report. Consider upgrading for access to premium content, but even without premium, there's plenty of free content daily, so visit metalsandminers.substack.com to join us and explore. And thank you again for watching this interview with Rick Rule. Now, I'm positive that you've been enjoying the back and forth conversation we've been having. Please let Rick know by hitting the like and subscribe button and leave a comment below the video. All right, Rick, let's finish off our discussion with what we discussed earlier, the lightning round. I'm going to ask you to rank a few assets as a buy or a sell. 100 is an extreme buy. 1 is an extreme sell. We'll move through them pretty quick. So just give a 1 or 2 sentence reason as to why you take that position.
Let me disclaim this. These things are widely popular with your listeners, but they're snapshots in time. A piece of news could come on the 11th of June that renders everything I just said irrelevant. So understand them for what they are. Value in the education, there's very little value in the quote.
Fair enough. All right. On a scale of 1 to 100, is gold a buy or a sell, and why?
I do 1 to 10, 1 being best, 10 being worst. Gold's a 2. 1 being best.
Okay.
So you would say 20, I guess.
Give it a,
or no. You would say 80,
or
I
reverse
guess,
an 80.
80,
yeah. I'll figure out the number there. Okay. So, and why do you take that position?
I'm sorry?
And why do you take that position where it's a 2?
A 1 which would, in your parlance, be 100, would suggest that there were recent events that made gold oversold. The higher gold goes, the less attractive it is to me. I'm a value buyer. I believe, well, let me rephrase it. I don't buy gold because I think it might go from 3,500 to 3,750. I buy it because I'm afraid it's going to go to 1,200. The consequence, I would rather.
You mean 1,200 or 12,000?
Yeah. I'm not a trader. Given that I'd like to buy more, I'd rather see it cheaper than more expensive.
Fair enough. Me too. All right. Gold miners.
Depends on the cap. We've moved into the market now where the high quality companies, but not as high a quality as what I would have talked about last year on your show, the Francos, the Wheatons, things like that. Leadership is changing. I still think for most people who aren't willing to do the work that they should settle for higher quality companies and a little bit less performance. In other words, they should still buy the best of the best, unless they're willing to do the work. That's a different question. If you're talking about the sector as a whole, leaving out the penny dreadfuls, you know what I'm saying? Leaving out the sub $100 million market cap where they're just looking for this stuff, but they don't have any. I think you need to give the gold mining industry, in your parlance, a 90. The leadership has already happened by gold. We are already seeing margins blowing out. We are already seeing aggressive investments by bigger companies in the smaller companies. We are probably a quarter of the way through this bull market, and it's the end of the bull market that provides jaw-dropping gains if you're smart enough to take them.
Yeah. Well, this is a wonderful time to be in this space. Physical silver.
Physical silver, I am still a little more ambivalent about. I don't know when the trade's going to take over, and I've always been myself, as a metal investor, a gold guy, because I've always owned it as insurance rather than as a speculator. So I would say myself, with regards to physical silver, I would have it as a 4 on a scale of 1 to 10. That means, in your parlance, a 60. But I would caution.
I'm sorry. Go ahead.
That your listeners need patience. It could easily be 2 years or 3 years before silver breaks out. It could also break out next week.
Yeah, I'm in the camp with you that it's probably going to take a little while longer. If we're only a quarter of the way through and silver moves near the end and is the most explosive move near the end, then logic would say we're still a significant time away from that big move. Silver miners.
If you talk about the length and breadth of the silver mining industry, which is to say all the penny dreadfuls that don't have any silver but they're looking at it, I would have to say that the industry as a whole is a 7. It's an enormously inefficient business filled with dreamers, scamsters, and frauds. And that extends pretty far up the feeding chain. There are a couple stocks that are amazingly responsive to the silver price that are lousy companies. If you, however, confine your picks to the higher quality companies with higher quality, higher grade, larger accessible deposits, this is the sector that has the most upside relative to current market caps I know. So I guess what I'm trying to say is if you are a stock picker, a good stock picker, if you are willing to do the work, you're talking about a sector that can scream. If you aren't willing to do the work, go do something else with your money.
Copper.
Copper's going to take a little time, I think. It's inevitable. It's absolutely, positively inevitable. But I would have copper as a 5 right now, uh, simply
Makes
because
sense.
I don't see the copper stocks or copper as being overwhelmingly cheap in the near term. $5 is not enough money to bring a lot of new production online, but it is enough money to incent current production and to maintain sustaining capital investments. And if we are on the cusp of a recession, or if we're in a recession, then in the near term, the copper quote goes lower. I'm not saying that will occur. I'm not smart enough to
Yeah.
tell you.
Yeah. No, that makes sense. All right. Uranium, the metal.
Uranium, the metal, I would have as a 4. So you would have as a 60. I think it's inevitable. I think it's underway. I think it's under-owned, and I think it's underappreciated. Yeah, there is the lunatic fringe on X, which I'm part of. Uh, but really, if you took it out to the investment community as a whole, they couldn't spell uranium.
Yeah. It'll have
I
its
believe
day,
it.
right?
Well, it has. The
Yeah.
last 3 months have been pretty
Uranium
good.
mine. Yeah, that's true. Uranium miners. We'll go with the high quality. We'll just
I
stay
mean,
with the high quality
if you give
ones.
me one name, Cameco, I've upgraded Cameco to a 3. Uh, my, which you would have as a 70. My concern with Cameco was that they bought Westinghouse, and I didn't know that they knew how to operate an engineering firm. The first quarter, the
They've
first
done pretty
quarter
well,
where
right?
Westinghouse was in their control, it looked like my worst fears were going to be confirmed. This last quarter was a blowout quarter,
Didn't they add over $100 million to the
blowout
bottom line?
quarter. And if we are, in particular in the United States, going to see a new construction renaissance, I'm not saying that we will. The technology that we will use will be Westinghouse technology. These will be American reactors built in America with American money. Um, it's difficult to understate how important that is to Cameco. Cameco will supply the uranium, they'll supply and operate the reactors, they will supply the refueling and reprocessing, and they will supply the disposal. This, if it occurs, will be an annuity. Never mind lasting for my lifetime. I'm 72. It's an annuity that'll last for your lifetime, Gary.
Yeah, kind of reminds me of Exxon
Correct.
in the oil space, right? Let's go to oil.
As a commodity, I probably have it as a 4. It is selling, I would suggest, at a price that doesn't incent um, either sustaining capital or new project investing. And the cost of capital is going up. Interest rates are going up. Oil stocks are going down, which means the equity cost of capital is going up. Uh, Drilling in popular U.S. basins is declining rather dramatically. Uh, so I'm pretty attracted to it, but it's economically sensitive. We are seeing the oil price falling even as production falls, which suggests that never mind forward-looking demand, but current demand is much less than the market was forecasting or is accepting. So in the near term, you could easily see softness in the oil price.
Yeah. Okay. The NASDAQ.
No opinion. I'm not a general securities
Okay.
analyst. I just take note that Warren Buffett, uh, who has a lot of pretty good ideas, is running $1/3 trillion in cash.
Amazing. Okay. So should I assume the S&P
Yeah,
500, same
I
position?
don't know what I'm doing. The S&P 500 is so overweighted the big tech stocks, and I'm not smart enough
Yeah.
to know the impact of their technology. There's a lot of people who don't care about things like fundamentals. I happen to be one who does, and if I don't understand them, I don't play. And I don't play in the S&P 500 because I don't understand the dynamics of 30% of the market cap of the S&P 500.
Okay. Short-term treasuries.
Short-term treasuries, I have to be a bull. You, despite the fact that you are receiving a negative real interest rate, in this circumstance, any investor who isn't maintaining liquidity is a moron. And short-term treasuries, I would define as less than 2 years, are a wonderful place, to, except for the fact that owning them is treasonous, a wonderful place to park money.
Okay. Long-term
Long-term
treasuries.
treasuries, I wouldn't touch them with a barge pole. I mean, I wouldn't buy them
Mm.
with the money from somebody I dislike. I believe that interest rates rise, which means the capitalized value of those distributions fall. Um, I believe that the purchasing power of the coupons that you're going to get in the future are going to be worthless. I'm old enough to remember the decade of the 70s. In the decade of the 70s, the prime rate went from something like 5 to something like 16. People who held long-term treasuries, there's a woman named Horace Dodge from the Dodge family. She was in the safest possible investments, which is to say long treasuries. And I think her net worth declined by 80% over the course of that decade. Hardly riskless.
Wow. Wow. Okay. So I guess you're putting a zero on that one.
It's tough to go lower than zero.
Yeah. All right. What's your opinion on a
Don't know.
recession?
Don't know.
One
That's
that's
not what I do.
no.
Acting for
What about
myself,
inflation?
I'm acting as though we are going to have an economic slowdown and that there's a possibility, a high possibility, of a liquidity driven panic or sell off. If I'm wrong, that means I suffered opportunity cost. Done that before, no
Yeah.
problem.
Yeah. So, do you see a
I do,
stagflation
sadly, I
environment
do.
where we have you do?
I wish I didn't. I lived
Okay.
through that before.
Yeah. So rising inflation at the
Yep.
same time. Okay. Would you share, Rick, a key takeaway that you want the viewers to keep in mind about today's economic, market, and monetary situation, and then let everybody know where they can learn more about your work, how they can connect with you, and then after that, we'll talk about Boca
First
Raton.
question, pay attention to the math, not the narrative. Trump, as an example, is a divisive figure. People like him, people don't like him. Their expectation as to the success or failure of the Department of Government Efficiency is often really hidden rhetoric about him.
Right.
The Department of Government Efficiency is not going to work. We tried it in 1980 with the Office of Management and Budget. The most recent Trump budget, where he proposed scrapping the debt ceiling, but at least raising it, and proposed the fourth highest deficits in U.S. history, tell us everything you need to know about the Department of Government Efficiency. This isn't a criticism of Trump. This is simply to say, divorce your narrative, divorce your politics, divorce your feelings from arithmetic. That's all I'm asking people to do. If you can feel perfectly comfortable with the direction of the country and the society of the country, but when you look at the fact that the cost of living, as I see it, is increasing by 7.5 or 8% compounded, and the interest that you receive on U.S. government securities is 4.5%, pay attention to the delta, not your preference. That's what I would ask people to do.
Okay. All right, you want to share where folks can get a hold of you, where they could find your work, and then you're once again hosting the Rule Symposium the second week of July down in the beautiful Boca Raton area of Florida. You're going to have an amazing guest speaker lineup. I just interviewed Dr. Nomi Prinz the other day. I'm going to be interviewing a few others that you have on your panel, Andy Schechtman and Dana Samuelson and a few others. You have an incredible amount of resource investing education that's going to be happening during that time, information to share. I'm going to be attending. I can't wait to be there. Would you share about that as well?
Let's start. The easiest way to get to know what I have to say about natural resources is to personalize it. Go to ruleinvestmentmedia.com, list your natural resource stocks, and I'll personally review them. Note I'm about 250 behind right now, so be a little patient. This is absolutely free. List your natural resource stocks. Please, no pot stocks, no tech stocks, no crypto. Leave an old guy to do what he does. But Rule Investment Media, list your natural resource stocks, I'll rank them. My educational site is the Rule Classroom. There's over 200 hours of instructional programming, including an 11-part series called Introduction to Natural Resources, which is where we tell you how to do stock selection. Wonderful price. It's all free. If you're going to be in the space and you're prepared to do the work, learn how to do the work at the Rule Classroom. The Rule Classroom has 4 courses a year called boot camps, deep dives into individual topics. We've done uranium, we've done silver, we've done royalty and streaming, we've done soul risk exploration, we've done the majors. These are not free. They're 8-hour deep dive sessions. They cost you $99 to attend. You have tapes that you can review for a year, and you're going to need them because we give you more information in 8 hours than you can absorb in 8 hours. And by the way, every educational product sold by the Rule Media companies comes with an ironclad money-back guarantee. If you think you didn't get $99 worth, I'll give you your $99 back, which takes you to the real product, the Rule Symposium. I'm informed, perhaps correctly, perhaps incorrectly, that this is about its 30th year in existence. We've tried to make it a little bit better every year. And after 30 years, I got to say, it's pretty damn good. Why is it good? Big picture macro, the kind you wouldn't get from CNBC or CBC. Macro that doesn't come from journalists, but rather comes from players. You interviewed Nomi Prinz. We talked to Nomi Prinz about the structure of Wall Street. She's no journalist. She was a partner at Goldman Sachs, right? She lived in the belly of the beast. We talked to Daniela DiMartino Booth about the Fed. She was a Fed researcher. I just interviewed Jim Rickards before I came on your show. He'll be there, talking about the intersection between Wall Street and Washington. He was general counsel for long-term capital management and then worked in the CIA for 10 years. A player, not an observer. Once we've shown you from players the way the system works, the way the world is, we talk to you about how to do something about it. We have analysts and portfolio managers with 30 or 40 years experience in natural resources, not some flunky from Wall Street who couldn't do supermarkets and couldn't do bonds that got stuck in gold because it was a small asset class, but rather people who've made money through thick and thin in resources, telling you what you did right, telling you what they did wrong, telling you how to be a better speculator. Then we have the living legends, my favorite part of the conference. Gentlemen like, Robert Friedland or Bob Quartermain or Ross Beatty, people who've built multi-billion-dollar natural resource companies from scratch, telling you literally how to identify the $20 million market cap that's going to be a $3 or $4 billion market cap. Nothing better than that. Every single exhibitor, Gary, at my conference has been personally vetted. If we don't own those stocks in our portfolio as sponsors, they don't get on the floor. We turn down more exhibitors than we accept. Fact. No other investment conference that I know vets every single company to the extent that they have to own them before they're admitted on the floor. And finally, the great guarantee. Whether you attend live or live stream, you will have access to all the conference recordings for a year. You're going to need them because we give you more information than you can absorb. We interview every company before they show up so that you can familiarize yourself with the companies, reach out to the companies, learn about them before you get to the conference. Allocate your time and attention better. And that lets me make you an extraordinary promise. If you come to the conference either live or via live stream, and you think for any reason that it wasn't worth the price you paid to attend, I'll refund your money. No other conference I know has an absolute unconditional satisfaction guaranteed or money refunded. So July 7 through 11 live, which I would prefer. You get to see Gary, or if coming to Boca Raton is inconvenient, join people from 33 countries watching the conference via live stream. In either case, you'll get recordings of the full proceedings to refresh your memory for a year.
It's as amazing as you say. To be honest with you, it might even be more amazing because the group of people that are assembled there are of like mind, and they're going in the same direction. They think about the world the same way. They believe very similarly, and they're all looking towards the future in the same way. I could testify to the spirit that is there, the joy that is there, the learning that is there. It is just an incredible time, Rick, and I appreciate you putting this on.
You made a really good point. The idea that all the knowledge in the room flows from the dais to the assembled is ridiculous. There are hundreds of high net worth veteran natural resource investors. There will be at least 4 family offices that represent mining and or oil and gas families. And the representatives of those families will be at least sophisticated as anybody that you'll see on the dais. So when you're there,
That's true.
I'm not encouraging you to insobriety, but hang out at the bar, visit with some people, show up for the meetings over coffee, visit with your fellow attendees, because this is a community around natural resources and precious metals, and it's a community. We'll have over 400 carryover attendees from last year. This is a group of people that like to hang out, share knowledge, and make money together.
Absolutely, 100%. And it is fantastic. So everybody who's listening to this, I will have all the information on the screen. It'll also be click throughable in the description area. You really need to strongly consider going or virtually attending, but you get a much richer experience when you attend. So if you can and make the time, you could always make it a vacation, a dual vacation. It is way worth the time. Rick, thanks for coming on to Metals and Miners, being so generous with your time, analysis, and ideas. I always love having our conversation. I look forward to having you back on sometime soon. Everybody else, thanks for watching. Well, this has been an awesome discussion, as we always have, Rick, and I want to welcome everyone who's tuning in to the fantastic interview with Rick Rule, founder of Rule Investment Media and the Rule Symposium, among other businesses. Before we wrap up with our final set of questions for Rick, I want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join our quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio, and that's the name of the report.